So welcome back. Here in part two of our ethical presentation, I would like to share with you how we build an ethical portfolio at Thomas & Thomas. The first thing we do is we look at the asset allocation that we're going to use for that portfolio. Now, this is actually no different than the approach we would take when we're building a mainstream portfolio. We want to make sure that we've tried to achieve something called negative correlation within our portfolio. So in other words, that we're not investing all into one area that could go down altogether, but hopefully that we've got some spread there, really the good old-fashioned tale that never have all your eggs in one basket, or in this case, never have all your licorice all sorts in one basket. So hopefully that helps a little there. The next thing we do is we have a look at the actual screening. Now, we talked about screening in part one. That's where we will apply both negative and positive screening to see, okay, what funds would fit the asset classes, the asset sectors that we're looking for, and of those funds, how many promise to undertake a full ethical screen of the underlying stocks, and we will read carefully the policies that those fund managers provide. If they don't provide a policy, we're not interested. We want to know that they're actually practicing what they're preaching and that they're not just what we call greenwashing. So by looking carefully at each fund, we can usually whittle it down from several thousand funds to actually less than 100. The final step here, if you like, the third step, is that we look then at the actual quantitative and qualitative research for those fund managers. So having performed the asset allocation and then the screening, we're now looking at, well, okay, how good is this fund manager? And we're looking at the numbers, which is the quantitative research. How have they done over the years? And then we're looking at the gossip, the qualitative research. What do we know about that fund manager? What's their volatility control like? What are their views like? Have we met them? Do we know what their team is like? And so when we pull all of that together, we're able to build the portfolio from there. But wait, there is, of course, a step 4. And in some form of an apology, really, to cat fans, I managed to find a very cute cat for this slide, as I know we picked quite an ugly-looking cat for the first one. Apologies, of course, if that was your cat. Anyway, here, the step 4 is this. We maintain the portfolio, and this is really the key difference. We believe that it's so important to keep up to date with the portfolio. So what we do is we will first of all carry out a quarterly pro-ethical review. This is where we take 1 week out every 3 months and we fully drill down and we look again at the quantitative and qualitative research of the funds. We fully screen those funds and we check that the asset allocation is right. This is something that the whole team is involved in. We don't see clients over that week, and it's really about understanding, okay, are we happy with our ethical portfolio? And we'll have a model portfolio for each section of risk that we are using for our clients. And if we're not happy, we'll make changes. So we revisit all of those steps and we fully backtest the portfolios to make sure that they're not becoming too volatile. This is particularly relevant within the ethical space because we are working with less funds than we normally perhaps will be able to use, and indeed those fund managers might well be working with less stocks as well. So volatility control on a regular basis is crucial. What we then do is we report back to all of our clients. We either tell them that everything is okay with the model portfolio and they will hold the same one, or we will say that perhaps something needs changing and we'll ask for their permission to make that change. We usually find that we have over 75% of our client responses within 24 hours, which is pretty good going. Once we've gathered responses up, we then rebalance all of our clients' portfolios to exactly match the ethical portfolio that we're recommending at this time. The final thing we do is we share a good news story every quarter with our pro-ethical clients. This is where we'll drill down into the underlying stocks within the funds, within the portfolios, and we will find out perhaps something that's going on within those companies. And it might be something to do with perhaps someone who's managed to design a water-saving toilet to be used in countries where there's very little water supply, or it could be a company that's sharing their data and materials for free with nurses in Africa, etc. We find this really useful for our clients, and they do really enjoy this part. But wait, I managed to get the cat back in again. There is a catch, really, with ethical investing, and I've already alluded to that, and this is the narrow diversification. So, yeah, it can be that the portfolio becomes a little more volatile because we don't have as many funds to choose from, and as I say, the fund managers also don't have as many stocks to choose from as well. So the grumpy cat's back, but we believe we can control this within certain parameters anyway. I thought it would be really useful today just to show you very, very quickly some comparisons between our Thomas & Thomas model portfolio, both in the mainstream and in the ethical space. So rather unimaginatively, we've got our Thomas & Thomas Blue, which is our mainstream portfolio here, over 5 years. And we've also got our Thomas & Thomas Pro Ethical Level 2 over the same period of time. Now, we've ironed out the kinks here. This isn't an exact replica, but what this is just literally performance points at each of the years over the last 5 years. And of course, it's really important to emphasize that the past is not a guide to future performance. But what this does show you rather hearteningly is that the green line does almost an identical return to the level 2 mainstream. In fact, it manages to slightly beat it in recent times. We found this really encouraging because for many people, they will say that ethical doesn't perform as well as mainstream. Well, we're not quite seeing that in every area. So okay, let's have a look then at level 3. As you know, we have 5 levels of risk from 1 to 5. So this is level 2. Let's move on up to level 3. So level 3 shows you the blue line and the green line, absolutely neck and neck, year on year, until, again, probably the last 12 months, where the green line has pulled away slightly. You can see returns. Again, these are historical, they're not guaranteed, but these are the exact returns as mapped out from Financial Express data. And you can see the Thomas & Thomas mainstream portfolio coming in at about 53% or so over the 5 years. But the Thomas & Thomas ethical coming in at about 55–56% over the same period of time. So if you'd held the ethical version of our portfolios, indeed, you'd have been no worse off in this instance. But what about level 4? Now with the level 4 portfolio, as we go up the risk scale, we will pull in more of the Far East and emerging market story. And in those areas, it is harder to find good ethical funds because those countries are often not as geared up to act in a way that we would find acceptable for our ethical clients. And you can see here that the blue Thomas & Thomas mainstream level 4 had enjoyed a very good run actually over the 5 years, coming in over 70% over that time. But nonetheless, the pro-ethical level 4 also was impressive, coming in at around about 65% actually. So it didn't perform quite as well as the mainstream, but it still performed very nicely indeed. Now, as I say once again, this is only the past, but it is a very useful tool for us to be able to evidence that ethical investing does still work. That concludes our second part of our ethical presentation. We had a question session for our clients, which was very, very spirited and enjoyable. And I hope that you've enjoyed this small podcast today. Thank you.